Good afternoon and welcome back, everyone, to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we're here back for part two of a session that I did from 2 weeks ago on how to find high probability stocks for maximum weekly income. And on that session, we laid out a strategy around how you can identify stocks that you can generate the most amount of premium selling options for weekly income with, specifically ones where you have the highest probability of success on those specific names. And at the time, what we did is we laid out the strategy. We showed you how you can find those specific stocks using the OptionsPlay platform. And what we did is we paper traded those ideas using the OptionsPlay platform. Now, fast forward 2 weeks later, what we're going to do is we're going to look at all of those positions, and we're going to walk through how I would manage those positions. And the first session, if you missed it, is available on YouTube. We will post a link to that session here in just a few minutes in the chat window here. But we will make sure that you have access to the recording so you can watch along and at your own pace, so that if you missed that first one, you can go back and review the overall strategy and, more importantly, how you use the OptionsPlay platform to identify these specific stocks. So like I said, what we're going to do today is we're going to review those positions. We're going to show you how I would manage those positions, the winners, the losers, and then also take a look at kind of the next round of positions, how we would potentially find new opportunities to generate more income on these sessions. So as a reminder, for those of you that are new here to OptionsPlay, we host these sessions every single Thursday afternoon to help you, empower you to become a more confident investor. We cover everything from technical analysis, fundamental analysis, trading strategies, mindset, trading psychology, everything that we feel you need in order to succeed as a trader, a well-rounded education, not just focus on option strategies or technical analysis, which arguably are important, but not enough to actually help you grow your account in the long run. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will be using as example purposes during today's session. So, in our first session, what we did is we helped you learn how to identify the best stocks for selling options for maximum weekly income. We looked at specifically how do you identify the optimal stock picks, then talked about the option strategies to maximize your options income. And just to quick review, for those of you that are joining us for the first time, again, if you want access to either the previous slides or today's slides, sign up for a free 30-day trial at optionsplay.com in order to get access to your OptionsPlay account. That's going to allow you to follow along during today's session so that you can find these same trades that we are going to review during today's session using the OptionsPlay platform free for 30 days. And it's going to allow you to have access to the recording and the slides from 2 weeks ago, as well as today. And Philip, if you don't mind, could you please just find a link to the recording from a couple of weeks ago and post it into the chat window so that everyone can see that recording for those that have missed the first session. But we identified, we basically laid out a strategy where we're trying to identify stocks that have a high bounce potential, that also have a high implied volatility to maximize our income. And what we're looking at is to sell 3-week put options and hold it for roughly that 1 to 2 week time frame. So now that we are 1 to 2 weeks in, or rather 2 weeks in, we're going to review those positions and we're going to show you how I would manage these positions. The thought process that goes into managing these positions, I think, is a skill set that a lot of investors struggle with. And this is something that I want to spend some time today reviewing all of the positions that we opened individually, one by one, how I would tackle each one, and and how we would close out or roll each position, and then look at new positions here as well. So just a very, very quick recap, because I'm not trying to redo the whole session, but what we're really identifying are more counter trend trading setups, because that's where we have the highest probability of a quick move in one direction to potentially maximize income. And counter trend trades, meaning stocks that are severely oversold that we believe is going to bounce in the other direction, are typically the trades that have the highest implied volatility, where you're going to maximize income generation. We showed you how you can use the OptionsPlay platform to scan for opportunities for these specific counter trend setups. And then last week, we also showed you how we can place these ideas or these trades using our paper trading portfolio. So especially if you're new to these types of strategies, how you can follow along without risking real capital, test out these strategies, test out these types of opportunities before you risk your real dollars on that. So let's take a look at the OptionsPlay platform here. So in the OptionsPlay platform, on the upper right-hand corner, you will see a portfolio tool. And this is really where you're going to find, if you are using the paper trading feature, how you find your positions. So we're going to go to our portfolio tool here in the upper right-hand corner, and we're specifically going to look at the portfolio that we created 2 weeks ago on weekly income. So we're going to look at our portfolios, and what I'm going to do is I'm only going to select that portfolio here from 2 weeks ago, that weekly income portfolio that we created, that we created 2 weeks ago. This one right here. I'm just going to select that. We're just going to look at the positions in there. There are also other portfolios. For example, you can follow along with all of our daily play trades here as well. So for example, you can just look at all the positions that we currently have in our daily play portfolio. Right now we have 1, 2, 3, 4, 5, 6 positions in our daily play portfolio. It's a great way to stay on top of the open positions that we have sent you trading signals on a daily basis. So if you're a current OptionsPlay subscriber, we're sending you daily opening and closing positions on our trade signals. We track every single one of those using our portfolio tool. So it's a great way to stay on top of your portfolio, a paper trading portfolio, or the trades that we send out to you every single day. So again, today, we're just going to focus our attention on the weekly income portfolio that we created a couple of weeks ago. And just to kind of show you how to set up your own portfolio if you have not already done so. Whenever you are using the OptionsPlay tool, when you click on the trade button, it will give you the opportunity to add a position, any position that you're looking at, into the portfolio. And it also at the same time allows you to create a new portfolio if you don't currently already have one. So if you're using this for the first time, you don't have a portfolio created, what you can do is you can go in there, create your own portfolio. You can use it as a way to track your you can use it as a way to track a real portfolio that you have, right? So for example, let's say you have an account at Schwab and you have an account at Tasty Trade. You can set up 2 separate portfolios here at OptionsPlay, and every single time you execute a trade in one of those accounts, you can add those positions into your OptionsPlay portfolio. And what that allows you to do is basically track both portfolios from one login, right? You log into your OptionsPlay account and you'll have your Schwab and your Tasty Trade account available to you, your positions. You'll be able to see your positions and how they're doing. We track all positions that you currently have. Or if you just have a paper trading portfolio, you can do that here as well. So that's what we did here last week. And in our paper trading portfolio, we put on 5 different positions here last week, 2 weeks ago rather. So 3 of them are winning, 2 of them are losing. So what we're going to do is we're going to go through each one, and we're going to show you how I would look at each individual position, what I would do with each one, how I would manage it, close it, roll it, and then also at the same time look at some new positions here as well, just to kind of help you reiterate some of the things we went over here last week, and what we went over last 2 weeks ago, and how I would proceed with it. Okay, so we have 5 positions. Like I said, we have 2 losing positions right now, and those are the ones that I would number one focus on, right? So whenever you look at a portfolio, it's always the most difficult, I would say, for a lot of traders to figure out what to do with losing positions. And this is really where if you spend enough time with traders, especially professional traders or traders who are more successful, you realize that the more successful they are, and specifically professional traders, they really spend the least amount of time on their losing positions. And that might be, and you might find that to be counter to what you might do as a retail trader. And the reason for this is because if you put yourself in the shoes of a professional trader for a few minutes, and it'll become very obvious as to why this is the case. Because when you are a professional trader, let's say you are a prop trader for a prop firm, or if you work for a market maker, you work for a bank, you work for anywhere where you trade for a living. Um, the number one rule, or the only rule that you really have that's instilled in you by your employer, is a risk tolerance. Meaning, for every individual position that you take, there is a maximum risk that you're allowed to take. Usually, that is a percentage of your portfolio. I would say most professional shops are somewhere probably closer to around 5% of their entire book can be risked in one single position. So firms let their traders have say in terms of what they trade, but they don't have any say in terms of how much they're allowed to risk. There's very strict rules around how much they're willing to risk. So traders have to calculate how many contracts they're able to trade or how many shares they're able to buy based on those specific rules. And if you are ever in a position where you are exceeding your maximum risk, usually there are either automated ways to liquidate your position or automated ways to ensure that you do not exceed those risks. And if you ever exceed those risks, effectively, you will find yourself out of a job. And that is distinctly the primary difference between a retail trader and a professional trader, is how much risk you're allowed to take. Because as a retail trader, no one sets those rules and no one forces you to stick to those rules. You have to do it yourself. Number one, I find that most retail traders aren't even aware of such rules that make it really impossible, if you will, for you to blow up your accounts. Number two, you don't have the oversight to force you to stick to those rules. And that is largely what differentiates retail traders from professional traders. A lot of people think that professional traders have access to some kind of secret strategy or indicator or some kind of better data than you, and that's why they're more successful. And it's not. It's because they never blow up their accounts. They literally never blow up their accounts, or very, very rarely blow up their accounts, because of these very strict rules. And by not blowing up their accounts, the upside is always going to be there, meaning the potential for the upside is always going to be there. But for retail traders, what happens is that the upside potential is there, but usually before you reach your upside potential, you've suffered from large enough losses that prevent you from actually actualizing your upside potential. Does that resonate with anyone? Please type 1 into the chat window, or type yes, or give me a thumbs up in the with the emoji button at the bottom if that resonates with you. And especially if those of you that struggle with growing your account and struggle with being profitable in your account. This is the lesson that I think you really need to learn, and this is the lesson you really need to hear time and time again, because it's not the concepts that I'm talking about, incredibly simple. The actual implementation of it is what's really difficult for a lot of traders, right? As a professional trader, you have no choice. If you don't stick to it, you're going to be out of a job. As a retail trader, no one forces you to stick to these rules. But that's really what's really important, right? And I'll talk to some of it as we go through the individual trade ideas, individual trades and how to manage it. But that's really kind of the true difference that separates a professional trader from a retail trader. It's not what strategies you're trading or what data you have access to. Yeah, granted, professional traders have typically some kind of honed in strategy that's been back tested and proven, and they usually have access to good data or reliable data. But that I don't think is really what truly is why professional traders are more successful than retail traders. What truly is the difference is that professional traders will almost never blow up their accounts because of the rules that have been put in place that prevent them from blowing up their accounts in the first place. Okay, so let's kind of dive into this a little bit further, right? Because when trades don't go in the direction they expect it to, that's really where the rules for what to do with those positions are incredibly black and white, straightforward, and require zero additional thought or thinking as to what you should be doing. And the whole point of this is so that you spend as little time as possible, as little mental energy as possible on your losing trades. Because losing trades are effectively the market telling you that your thesis on a specific trade idea is wrong. And whenever something is proven you to be wrong, the best thing to do is to walk away, even though that's the hardest thing to do. What you really should be spending your time on are where the market has proven you to be correct, because that's really where you can start turning a small win into a much larger win. Okay. And so if you look at actually the difference, outside of the risk management side of things between a professional trader and a retail trader, one of the biggest differences that I notice is that retail traders spend all their time worrying about their losing trades. They don't spend too much time on their winning trades. Yes, they overthink what to do with their winning trades, but they spend an outsized amount of time thinking about, okay, I'm down, $500 on this trade. What should I do? How can I repair this trade? How can I do this? And it's very obvious based on the questions that I usually get, right? Probably one of the most common questions that I get as a strategist is, I have a losing trade. What can I do to fix it? And I always tell traders that if you have a losing trade, don't try to fix it. Just let it go, because that's the market proving you to be wrong. Stop trying to prove yourself to be right when clearly you're wrong, right? And this is just kind of also another human nature thing, because in trading, you're likely going to be wrong 40-50% of the time, and it's really difficult as a human being to just accept the fact that you're going to be wrong that often. Because if you're wrong that often in any other area of your life, you would consider yourself a failure, right? If you were wrong 40% of the time when you do your work at work, probably you'd be fired if you're wrong 40% of the time. But trading is actually one of the places where you can be wrong 40% of the time, 50% of the time, even 60% of the time, and still be profitable in the long run. How often you're right or wrong has nothing to do with how profitable you are. And it's an incredibly difficult thing psychologically to get accustomed to. But the sooner you get accustomed to that and you can let your losers go and spend little time as possible on your losers, the more successful you will be in the long run. Because, like I said, the rules for losing trades are straightforward, they're black and white, and they require zero extra thought, right? If you have certain thresholds, once they exceed them, you cut your losers and you move on. And then what you do is you spend your time on your winners. You say, okay, I have a winning trade. The market has proven my thesis to be correct. How can I turn this win that I currently have into a bigger win? That's how you succeed in trading. You keep your losses small and you try to turn small wins into home runs. And if you can keep doing that over and over again, has nothing to do with your strategy, has nothing to do with how you pick your trade ideas. If you can just consistently follow that philosophy of keeping your losers small and focusing on turning your small wins into bigger wins, that's how you can succeed as a trader. So I know that was a bit of a long introduction, but that's what I'm going to spend my time walking you through during today's session. So I have two losing trades. I have Excellent Enterprise and Cloudflare. And these are both short call verticals. So these are bearish credit spreads that we entered last time, right? Now, as a rule of thumb for bearish credit spreads, once you lose 100% of the maximum potential gain on a credit spread, it's time to cut your losses and move on, right? So let's take a look at Exxon. We sold the 740, 780 call vertical. So whenever you sell a call vertical, you want that stock to stay below that lower strike. So 740 is about right here. Let's actually zoom in a little bit just so we can see this more clearly. I forget what the date of the last session was, but basically 740 is right here. And at the time, what we were looking for is a stock that had rallied substantially substantially and maybe was going to turn lower. But instead, the market has moved higher here. And this is an opportunity to basically say, my thesis that 740 was going to be an upside cap did not work out. The market kept moving higher, and I've exceeded my loss here. One of the great things about the OptionsPlay platform is that we calculate percentage P&L on your net position, which makes it really easy to stick to the specific rules that we put in place for these types of strategies. Once a credit spread loses more than 100% of the maximum gain potential, it's time to cut your losses and move on. So this, we're at 115% loss. Now, if I was tracking this every single day, I probably would have cut losses maybe a couple of days ago once it crossed that 100% threshold. But today we're at 115. You know, in the worst case scenario that I didn't look at my portfolio in a couple of days, I come back, I see I'm down 115%. There should be no further thought that goes into this, no further analysis, no further, let's look at some technicals, let's look at some fundamentals. And I know a lot of traders do this, right? A trade goes south in your direction and you say, okay, let me look at the charts. Is there something in the charts that say maybe it's going to start turning around now? If it is, I'm going to hold on to it a little longer, even though I've kind of exceeded my rules, right? Because whenever you do that, that's when you can potentially lose bigger than what you originally intended. And that's how, again, the difference between a professional trader and a retail trader. Professional traders are forced at that point to say, I've exceeded my risk limits, I'm going to get out of this trade. Retail traders, what you're going to do is you're going to find all different types of ways to justify continuing to hold on to this trade in hopes that it's going to come back in your favor. If you can relate to that, please type 2 into the chat window of where you have a losing trade. You have set rules for yourself, but what you do is you say, oh, you know what, maybe let me take a look at this. Maybe there's something I missed out. And what's interesting here is that this actually generated a new bearish trade idea here today. That would be a classic example of someone saying, hey, this generated a new bearish idea today. Why don't I stay in this trade for a little longer? Maybe it's going to come back, right? And I tell them, well, if it truly generated a new bearish idea and you think that now is a great time to short this particular stock, then actualize the loss that you have on the first trade, because clearly the timing on the first trade is wrong. Then decide for yourself, would I enter a new bearish trade today if I wasn't already in a losing trade and I'm just trying to make my money back? Most of the time, your answer is going to be no. Sometimes it is yes. And if that's the case, that's okay. Close out your first trade, open up a brand new trade, and manage those trades separately. Don't try to keep throwing good money after bad money. That's what a lot of people do, is they throw good money after bad money. Stop trying to do that. So in my particular case, I'm looking at this. I've exceeded the 100% rule. This should be very clear cut. Close my position, trade this, add it to my weekly income portfolio. I am out of this position, done. Nothing more that I should really be thinking about or analyzing on this particular trade. I've exceeded my risk limits. I'm going to move on. Okay, so now I've removed my losing position. Let's look at my next losing position, net Cloudflare. We sold the 162, 172.5 call vertical. Now let's look at this position. And this is a prime example of why the rule of thumb that we usually set for selling credit spreads is that you should collect at least 1/3 of the vertical width. So this is a 162, 172.5 call spread. That means that's $10 wide. On a $10 wide credit spread, we usually like to collect at least $3.33. Here, I've actually collected only $3.09. This is what I would consider a suboptimal credit spread in this particular case. But let's take a look at this Cloudflare trade, right? 162.5 is around, sorry. 162.5 is around right here, right? So at the time when I entered this trade, I was expecting this to stay below that level and maybe start trending back lower here. Instead, it has broken out higher and continued to move higher here. It generated a new bearish idea here today. Classic example of someone who's in a losing trade is grasping at ideas or reasons to stay in that trade. And if it generates a new bearish idea, that could be one. So I'm saying don't get tempted by that. Once you've exceeded your risk limits here, 100% of the total loss, get out. I don't even like seeing this type of loss, 157% loss, because I've collected less premium than I like on this particular trade, which is why I always try to collect 33% of the width, if not more, 40% of the width, because if I collect 40% of the width, I cannot exceed 150% loss. Only if I collect less than 33% of the width can it possibly lose more than 150% of the loss. Because if you collect 40% of the width, you have only a 1.5 to 1 risk to reward ratio. So again, there should be no further thought that goes into this. Clearly, my bearish view on this trade is wrong. Close out the position. You can click on the close position button here in your paper trading portfolio. Click on the trade button, add the position, and that position is going to be gone from your portfolio. That's how you want to think about these trades. So now I have 3 other trades that are winning trades. This is really where I should be spending my time thinking about what do I do with these positions, because these 3 trades are where the market has said, hey, your views on these specific stocks are correct. Let's see if this will continue in the direction that you expect it to, which, many times will happen. And now you have the opportunity to turn what is a small win into a much bigger win. And as long as you keep your losers contained and small, and you keep working at turning your small wins potentially into your home runs, eventually you will hit some home runs, and those home runs will offset your small losses. But that will only work if you keep your small losses actually small and not continue to hold on to it or throw good money after bad money. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so let's take a look at this. Now, we entered this trade. It's not a particularly realistic trade just because it's a $1,700 stock, but that's not relevant to today's conversation. Today's conversation is more about process and how you want to think about it rather than the individual trade ideas themselves. So we looked at this stock a few weeks ago, and I remember this pretty distinctly, right? This stock sold off very heavily. I forget what it was. Maybe it was earnings. The stock sold off very heavily. And the idea is that these heavily oversold stocks are the ones that, number one, have the highest implied volatility and also have a decent bounce potential here. And that's exactly sort of what we saw here with this particular stock, right? We sold the 1640, 1580 put vertical here on FICO. So let's 1640. So it's trading around down here, right? So as long as the stock stayed above 1640, this would have been profitable. And the stock has bounced up to 1755 as 1771 as of today's close. So we sold this credit spread for $18.15. It is now trading at $5.45. So we've collected more than 50% of the total width. We've actually collected basically 70% of the total width. That also triggers our take profit rules on credit spreads. Also, a credit spread that is only 15 days from expiration is also one that we typically want to manage as well. So here's an opportunity where the market has proven you to be correct, and now you could potentially use this as a way to execute a role, right? Meaning, if you believe that now, you've picked the right turning point on this particular stock, and now the stock is likely going to continue moving higher here. Now is the opportunity to turn the small win into a bigger win. Okay, so what you want to do at this point is what you can do is you can go to the trade button, and we can look at kind of if we were to sell a new put spread. What will we look at, right? So we're looking at now the July 18th, 1770 by 1620 put vertical. So this tool can help you identify, when you might want to roll, and then if you're going to roll, what to roll it to, right? Now you can change your strike prices. You can change that, but this gives you a good starting point here. Now we did talk about this from a weekly income perspective, right? So we generated 70% of the maximum gain in just 2 weeks. At the time, this was roughly a 30-day expiration strategy. I'm sorry, maybe a 21-day expiration strategy. 15 plus 14 is around 30 days that we had at the time. And this basically gives us the opportunity, and probably FICO doesn't have weekly options, right? Let me just check. Yeah, it doesn't have weekly options, so we had to use the monthly options. So basically what we're going to do here is we're going to click on the roll position button, right? We'll roll this, and what we'll do is we'll roll it out from June to July, which puts it out to 180 days. And what we're going to do for the July is we're going to sell that 1770, I think we said at the time, and then 1620. Let's do 1640, right? So this is the position that we have today. We're going to roll it to this one, and this is what we're going to do. So we're going to click on the trade button, add the position, and now the FICO trade that we had before, the July trade, is now going to be rolled out to the the June trade is going to be rolled out to the July trade. And now, as you can see, it resets the P&L to 0, basically, because we've closed out, we've realized the profit on the first trade, and now we are basically starting from scratch here on the second trade. And what we're doing is here, we're just basically continuing to do what we the views on the trade, right? And, we put out 5 trades last week. 2 of them were wrong. 3 of them are correct. Let's focus on the winning trades, and we're going to try to turn small winning trades into much bigger winners. Okay. So that's the FICO trade. TLT, we sold the June 13th $83 puts. TLT is now trading at 86. Bonds, at the time were pretty oversold, right? So we made it basically a new 52-week low last time that we were here, and we sold those 83 puts. We had a bullish trade idea here, and this is a prime example here. I think what we were doing last week here was that, we noticed that as we reached a new lower low, we were no longer making lower lows in terms of momentum. That was a good sign that, one, we were severely oversold. There was positive divergence. Everything that we typically see on these types of extreme moves that have a good chance of a quick bounce potential. That's a classic classic setup that we're looking for, right? So this is the counter trend strategy that we talked about last time. Identifying trend extreme. That's exactly what we saw here on TLT. Identified trend exhaustion, meaning divergence between price and momentum, right? So lower lows in price, no longer seeing lower lows in momentum. And then we can't find a fundamental thesis for TLT because it's a bond ETF, not a stock, but it gives us kind of everything that we typically are looking for from a technical perspective, right? Lower lows in price, no longer seeing lower lows in momentum. And this is really where you can potentially catch things right at that turning point. That's exactly what we did. We caught the turning point basically down to the day. So when I talk about finding high probability trading setups for this specific strategy, this is a classic sign up, and we were proven right by the market. So here's an opportunity now that we've been proven right to see, can this continue? It might not continue, but this is really where, if it does, you can start hitting some home runs, right? So now we sold this June 13th, $83 put. We sold it for 87 cents. It's now trading at just 6 cents left, right? So we've captured 93% of the total profit potential on this trade. This is a classic example of, where you are maximizing your weekly income. You don't have to hold this to expiration. If you hold it to expiration, you're only going to generate another 7%. Not worth doing, right? It's not worth holding on to another week just to generate another 7% when you've already generated 93% in the last 2 weeks. So here is a classic example also of what you might want to do to roll. So we go to the income tab here again. This is what we did last time. And now we're saying roll it to the June 27th, $85 puts, right? So great. The June 27th, $85 puts, that's what we would roll it to now. So we would go back to our position. We would click on roll. We still sold the June 13th, 83. We're going to roll it to the June, 27th, 85 puts, right? And that's what we're going to trade. So we're going to collect a new $1.47 from that particular trade. I'm sorry, our adjusted cost basis is now we've collected $1.47 from this position versus I think the first time we collected 87 cents. We're collecting another 66 cents from this position. So we click on the trade button, add position. Now we've kind of reset our TLT position, right? So we reset our FICO position, we've reset our TLT position, and what we're doing is we're just trying to turn small wins into bigger wins. We kept our losses small, and we're going to keep trying to hit home runs here. And then we're going to look at United Health. This was a short June 13th, 285 put. Let's take a look at the chart for United Health, right? So this was an example here where, again, price extreme, right? 285. 285 was right here. So we basically caught it right at that turning point, right? 285. I'll zoom in a little bit more and kind of hopefully see if we can make this a little bit clearer. This is a stock that has made a big move here in a short amount of time, right? So 285 is right here, right? So we got it just near the turning point here. And so, if you think, look at the stock, right? This was a stock that was a $600 stock in the middle of April. That was a $300 stock in the middle of May. So 1 month time, this stock lost 50% of its value. And using our counter trend strategy, we found the turning point nearly down to the day, right? So now the stock, we've identified that turning point down to the day. We've now identified, turning point. We traded at that turning point with using a short put, and now it's generated a new bullish idea here today. Great opportunity potentially, again, like I said, to turn a small win into potentially a much larger win. And this is really where you have the choice, right? We sold the June 13th 285 put. Let's say we were to sell a new put here today, we would move it up to the June 27th. We'd actually keep it at the 285 put. However, one thing that I do think, is an opportunity if it turned a trade signal here is that maybe you can now turn this into a call option or a call spread. That's one thing that you can potentially do. You've already pulled in $9.70 versus premium. If you buy a call spread here, it'll cost you $21. If you basically say, well, I'm basically taking $9 off the purchase of this $21 call spread, you're basically reducing the cost of that call spread in half, right? That's how you turn small wins into big home runs, because now you basically can buy this call spread for nearly half the price of what it really is going for in the market, because you've collected that $9.70. So this is really what when I say, once the market has proven you to be correct, you have a lot of different choices of what you can do. You can keep selling puts. You can turn it into a put spread. You can say, okay, you know what? Great. And now that I've collected some premium here, I'm going to trade a put spread instead of a put because I want reduced risk. Or maybe now I think that now that I've identified a true turning point, I think it's going to take off. So let me buy some calls or call spreads. You have a lot of different choices that you can do here. And let's keep this simple for now, right? Let's just roll this to a new put. Let's roll this position. We're going to roll it to the June 27th, and we'll keep it at the 285 puts, right? So originally we collected $9.75. By rolling it, now I'm going to collect nearly $14 on this particular trade. Let's trade that. Add that position. So now I've recentered all 3 trades in my position. And like I said, I spent a lot more time on my winning trades than my losing trades, because that's where I can start turning small wins into big wins. And I should be spending very little time on my losing trades, because that's really where the rules are very black and white, very clear cut. There's no ifs or buts. And let me look at this a little deeper. If it either exceeds your risk tolerance or it doesn't, and that's how you decide whether you keep a losing trade or you let it go. Okay. And then what I'll do in the last few minutes here is we'll just take a look at some new ideas. Let's just take a look at what opportunities that are still in this market, because realistically, this is how you would really manage a portfolio. You pull in, you look at a portfolio, you say, okay, have my losing positions reached my thresholds? If they have, you close them out. On your winning trades, if they've also reached your thresholds, you look at adjusting them, either rolling them or closing them out, or maybe start looking at buying some upside premium if you really think it can take off. And then at the same time, once you close out your positions, let's look at some new opportunities, right? Let's look at kind of counter trend ideas. And I'm going to use only counter trend ideas for now. And we'll look at both bullish and bearish ideas at the same time. And I'm going to remove the stocks that are not liquid, right? And maybe what I can do is I can even look at just stocks with high IV ranks and see what's available. At the moment, as you can see, there are 5 bullish opportunities. And if I use the IV rank, they have 16 ideas. Okay, so I have quite a few different ideas to look at here. And what I'm going to do is I'm going to sort it based on relative strength. I usually like to sort it based on relative strength to kind of get a sense for opportunities. So when I'm looking at bearish opportunities here, counter trend bearish opportunities, I typically like to find stocks that are, some of the strongest stocks in the market. And that might not make a lot of sense, but some of the strongest stocks in the markets are the ones that are most overbought, that have the highest opportunity of a potential sell-off here, right? So look at Carvana. Carvana, this was a $150 stock at the beginning of April, and is now a $350 stock a little over a month later. So the stock has generated over 100% gain. Is that the type of stock that could potentially start turning lower here? Potentially here. And also notice how the divergence thing that I was talking about here, right? So higher highs in price, right? No longer seeing higher highs in terms of momentum. So I'm just going to use this as an example here. We'll take a look at kind of what opportunities there are. Right now this isn't collecting a huge amount of premium here, so you are collecting roughly 1/3 of the premium here. Let's just take a look at, maybe taking a shot at a trade like this, right? We'll put it into our weekly income portfolio, add that position, and we're doing this all using the OptionsPlay tool. We've identified the opportunity using OptionsPlay. We've identified the strategy using OptionsPlay, and you can, in a single click, paper trade that portfolio, paper trade that opportunity. And then let's take a look at some oversold stocks here. Let's see what's available here. I think we've kind of reset a little bit here. One that I was looking at here earlier today, let's look at FedEx. FedEx generated a bullish opportunity here. Am I still only looking at, let's look at that. Let's look at only counter trend ideas. Let's look at Copart here. These are some of the weakest stocks in the market. So, so this is a stock that was a $64 stock last month, is now a $50 stock. So this stock has really taken a bit of a beating here recently here. Look at that momentum, as it kind of continues to move lower here over the last few days, momentum continue to move higher. That is a clear divergence here. And that is the potential for a big move higher here. So let's take a look at maybe selling a put option here. Now, Copart doesn't have weekly options, so I have to go out to July. Let's say June is only 15 days to go. Let's look at that 15-day option, right? It's a $50 stock. You can either sell the $50 for 75 cents. Let's look at selling that, right? So that's going to collect 1.6% of the stock's value in just 2 weeks' time. So that's a 48% yield annualized, even though you can't really look at annualized yield on something that's short as 15 days. 1.63% is the way to look at this. You're earning 1.63% of the stock's value in 2 weeks' time. This has a high bounce potential, in my opinion. And let's take a look at that. Let's add this portfolio to, let's add this trade to our weekly income portfolio. And then maybe we'll look at one more opportunity here. I don't know there's any other ones that I really love here. Maybe we'll take a look at Dollar General. And also, this is a new feature that we recently released into that I'm actually that I'll be doing. I'll be covering in an upcoming event. Basically, if you look at each individual trade idea next to it, there's a indicator that tells you if a trade idea is in an existing watch list. So if you look at GE Aerospace, if I click on it, it'll tell me it's in the industrial global watch list. It's in my personal buy right watch list. It's in the unusual volume watch list, and it's also in the bullish momentum watch list, right? And ExxonMobil here, as you can see, is also in the overvalued stocks category. So, so one of the things that we're working on right now is giving you more insights into these technical trade ideas alongside of if it's overvalued or undervalued alongside with it. So we're actually doing more work along this so that you can quickly identify, okay, which stocks that are bullish are undervalued, which stocks that are bearish are overvalued. This way you can align the technicals and the fundamentals directly on the OptionsPlay platform. So you're seeing kind of the early stages of that here in this feature that you're seeing here. So let's take a look at this. We had a position, the bearish position here in Exxon. And we did that a couple of weeks ago because not only was it bearish, it also was overvalued here. And granted that trade didn't work out at the time, but let's just say, this is now a better time to access this position, which, you have a higher high in price. It's overvalued, and it has a potential bearish potential here. So let's take a look at trading this again. At the time, we sold a credit spread. This one is a good risk reward ratio. We're risking 4,400 to make 2,500. So the risk reward ratio is actually better than 2-to-1. So I think this is an example of a trade that we might potentially add to our weekly income portfolio. So let's add that position. So now we have, again, 6 positions in our weekly income portfolio. We had 3 winning ones that we kind of adjusted. We got rid of 2 losing trades, and now we added 3 more positions. So now we have 6 new positions that we have, and what we can do is we can come back in a couple of weeks' time. We'll do the same thing here again, and walk you through kind of these positions, how we're managing it, and showing you how we can further turn, what our small wins into home runs at the same time cutting our losers. With that, that covers what I wanted to show you here today. Today was very heavy on showing you the platform, showing what you can do with the platform, and really walking you through the thought process that you should be having every time you log into your portfolio and you think to yourself, what should I do today with my positions? I'm going to keep trying to hammer this concept home because it's arguably, like I said, conceptually really simple to understand. Theoretically very easy to understand, practically difficult to implement because it's your real money on the line, right? You have this is fake dollars on the screen. It's easy to say here's what you should do when you have fake dollars on the screen. It's much harder when you're actually facing losing $1,000, $2,000, $10,000 depending on the size of your portfolio, and saying, okay, you know what, I'm just gonna without any emotion just take out of my close out my trade that I'm losing $2,000 on. Much harder to physically do yourself. So but the more times you see it, the more you see it being done, the more you see it working. That's kind of where you're going to likely a light bulb goes off and you say, okay, this makes sense. I need to start following a different process because whatever I'm doing today is not working for me. Let me try something new. And hopefully by doing these sessions where I'm actually walking you through real trades that we're following week to week, you're going to actually see the process and see how this works for you to actually actualize it and do it on your own. So with that, what I'll do is I'll turn this over to the Q&A session. But before I do, I'm just going to post this link here on my screen here once again. If you're joining us for the first time, you can sign up for the OptionsPlay platform, which will give you everything that I showed you on my platform here today for 30 days for free. You can sign up either at optionsplay.com/signup or point your phone to that QR code, and that's going to give you access to the recording, the slides, and the platform from today. Okay. So there is a Q&A window here at the bottom of your screen. If you can type your questions into the Q&A window, I'll try to answer as many questions as I have time for during today's session. Let's take a look at the questions. There's a couple of questions regarding, the link to the first session. So I'll post that link again into the chat window for everyone that may have missed that first session. Okay, the link is in the chat window if you missed that first session from a couple of weeks ago. I'm holding a deep in the money cash secured put on APP 5 delta. Deep out of the money on APP. Let's take a look at APP real quick. Whoops. What's going on with my mouse? APP. And you're saying that seems to be a liquidity issue because you can't close out the trade without losing 2/3 of the premium. So one of the first things that we like to do is we look at liquidity, right? So as you say, the stock is pretty liquid, but the options, as you can see, is not very liquid. That is usually a reason for me to not get into that particular trade from an options trading perspective, right? And if you're saying that you're holding a 627 out of the money, 627 5 delta. Oh, sorry, these are calls. A 5 delta put is somewhere around, let's call it a 310, right? A 310 that has a 95 to 95 with a midpoint of 195. My only suggestion to you is keep trying to work a limit order near closer to that 195 level. So you start at 195, move down to one. Sorry, you're trying to buy it back, right? So start at 195, then pay $2, then 205, then 210. See how far you can get on a limit order. I don't think you really need to pay 295 just because this stock trades 4.8 million shares a day. It's pretty liquid from that perspective. Yes, this is deep out of the money, but I think if you keep working that order, you might find the ability to get out of that trade, without paying $2.95. Uh, Derek, your comment about Tesla on the in the money trade, I absolutely agree. But rules are rules. You gotta move on, right? Because if you keep thinking that way of, hey, if I just hold on to this a little longer, maybe it's gonna come back. Yes, maybe 10, 15% of the time it does work out, but I'd say closer to 80% of the time it doesn't work out. So you can't maximize every single trade, right? And if you try to maximize every single trade, you're just going to drive yourself crazy. You got to think about the statistics of statistically what is likely going to happen and just accept the fact that some trades you're not going to get the maximum potential on a trade, and you might sometimes close out a trade only for a few days later for that trade to work out and turn into a profit, and you say to yourself, damn, I should have just hold on to it. But for every time that happens, there's probably 5 other times that happen where it doesn't work out in your favor. And that's what you should be thinking about is the long run. We should have the ability to rename the portfolio or delete it if not needed. You absolutely can delete portfolios. You can do it in your profile, right? So you go to your in the hamburger menu, you go to your profile, you go to your portfolio, and you can edit. I'm sorry, I'm not going to edit that one. You can edit this weekly income portfolio. So if you want to rename it, you want to do it your monthly income portfolio, you can do that and save it. So you can do that all under your profile under portfolio. So if you need to delete it, if you need to rename it, you can do that all under your portfolio. What is the maximum loss you can have before you liquidate the position? So the rules are different between debit versus credit. Debit, once you lose 50% of your premium that you paid, it's time to close out the trade. On a credit, once you lose 100% of the premium, 100% of the maximum gain potential on that trade, it's time to get out of the trade. And what's really great about the OptionsPlay portfolio is that we calculate the P&L for you right here. So it's really easy to very quickly visually just look at that and know, okay, either I've exceeded my risk tolerance or I haven't. How do you evaluate the time factor of an option versus profitability, taking losses early versus letting the option contract ride? Well, the time-based factor only comes into play if you've reached the time threshold without the strategy reaching kind of your pain threshold, if you will, right? So generally these rules are more relevant for short options. So if you're short a put, short a credit spread, short an iron condor, usually have a time-based rule that will start kicking in roughly about 2 to 3 weeks out from expiration. And that time-based rule really only applies if you reach that time threshold and the position has not reached either a take profit or stop loss criteria, right? And what you basically do is that once you hit that time-based rule, what you want to do is you want to roll your position from, let's say it's 2 weeks from expiration into another, let's say 30-day credit spread or short put or whatever strategy it is, and reset kind of from a time frame perspective, right? You would also want to reset your strikes to kind of recenter your strikes based on the current price. But generally speaking, most of the time, what you will find your trades, especially credit type trades, is that you will have reached a stop loss or take profit threshold before you reach your time-based threshold. But if you ever do reach that time-based threshold without triggering your stop loss or take profit, that's when you want to just roll. The best thing to do at that point is just to roll your position, reset your time, going out another 30 days days. And the whole point of that is just to avoid early assignment, right? Because if you're short a credit spread, an iron condor, a credit spread into the last week of expiration, you have a much higher risk of early assignment. And that's what we're trying to avoid. So what you do is you roll it out, 2 weeks out from expiration, and that kind of helps avoid that early assignment risk. In credit spreads, is the max risk fixed? Yes. Any type of vertical spread, any type of spread, generally speaking, the max risk is fixed. So no matter what happens, as long as you hold it to expiration, and it's not like one leg gets, assigned, and then the long leg kind of expires, and you keep holding on to the position past the expiration date. As long as you don't do that, again, that's why the time-based rule is important for credit type spreads. The max risk is fixed, and that's why you have no. I always get kind of these comments from people saying, I followed your trade or I followed someone else's trade and I lost way too much money. I can't believe you gave me such a bad tip or bad trade advice. And I always tell them, like, maybe my trade idea wasn't great, but the only person you can blame about losing too much money is yourself, because the only person that can control how many contracts you trade is you. So, and that amount that you risk doesn't change, right? Meaning when you enter the trade, at that moment, you know exactly how much money you could potentially lose. And if that amount is quote unquote too big, then unfortunately, the only person you can blame is yourself, right? The trade idea certainly wasn't a good idea, but you decided to trade way too many contracts. And that is the decision that you have to make. So I can't stress enough that whenever you're using the OptionsPlay platform, and I'm sorry I didn't get a chance to go through this today, right? But let's go back to another trade idea. Any trade idea that you trade, I always recommend to use the risk and investment calculator. This is a tool that we have built into OptionsPlay. And what you do is, before you use this tool, you go into your profile, you go to your risk and income settings, which is at the bottom here of your profile. And you can set what percentage of your portfolio you're willing to risk and what is the size of your portfolio. So I have it set to 2% on a $100,000 portfolio. And whatever, generally speaking, the 2% rule is you should leave it at 2%. I don't recommend you changing this, right? Some really experienced professional traders will go up to about 5%. But generally speaking, most retail traders start, my rule of thumb is 2%. The only thing you have to adjust is your portfolio size. And once you put in these settings, every time you place a trade, so let's say I want to sell this credit spread on FedEx, right? I want to sell this bullish credit spread on FedEx. What you can do is you can use the risk and investment calculator here on your strategy. No matter what strategy you're trading, click on the risk and investment calculator. It already pre-calculates how much you're willing to risk. So 2% of a $100,000 portfolio is $2,000. So the only thing you have to do is click on calculate, and it will automatically calculate for you that you can sell 2 contracts of this strategy. So, I forgot to mention this during our session, but every single time you add a position to your paper trading portfolio, you should be building into the habit of using the risk and investment calculator, so that when you click on trade, each trade that you're adding to the position will not exceed $2,000 every single time. And what it does is it automatically calculates the appropriate number of contracts for you, so that you don't have to, so that you never exceed your maximum risk tolerance. So even if you put on this trade, went on vacation, and came back 5 weeks later where this trade has already expired, no matter what happens, worst case scenario, this trade would not risk more than 2% of your total account value. Raj is saying, how do we make the winner make bigger gains? Well, you take a winning trade, you roll it, and now what you can take is make a winning trade into a much bigger gain, right? So basically, every single time I've basically rolled a winning trade into a new trade, that's the opportunity to turn a small win into a big win. Because if the second trade also continues in the direction that the market has proven me to be correct, right? Let's look at kind of that TLT position, right? Our thesis was that, the $83 level was a turning point, right? Our thesis that $83 turning point ended up being correct. So now that it was a turning point, if that turning point continues, right? Imagine if you had identified this turning point before, right? And you had sold an initial put here. And now you've made some money on that put and you sold another put here. And then eventually, maybe you eventually came back and sold another put here and another put here. Now you've had three, four winning trades in a row. Now you've turned one small trade into 4 winning trades in a row, right? That's how we think about these winning trades. So what we've done here is we've identified a turning point. We've been proven correct here once. Let's see if this can continue. If it continues, now you have 2 winning trades on the back of 1 winning trade. That's how we turn small wins into big wins. And every single time we're wrong, we basically cut our losses there, right? We never let losses exceed that initial losing trade and we move on. So all losing trades, once they exceed that initial losing point, cut it off, move on. Only do we focus on our winning trades and we turn small wins potentially into much larger wins. And worst case scenario, we basically turn a win back into a flat trade, right? So if you keep your losses small and wins kind of potentially go from small wins to flat trades and small wins into big home runs, that's your process to how to grow as a trader. Okay, so that's the time that I have for questions here for today. Again, I hope that this session is very different than what we normally do, but I think this is a really important session for a lot of traders to hear this process and really learn this process and better understand how do you actually do some of the things that we talk about with regards to position management, because that is truly what differentiates, like I said, professional traders from retail traders, successful traders from traders that struggle with trading. So I think the best thing to do is actually just show you how it's done week after week so that we drill in this process, and that's how we can become more successful as traders. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.